growth has always been a use case for subordinated debt, and as that deal activity has picked up, so has the interest in subordinated debt. And some have used it strategically to sort of fortify the balance sheet, anticipating maybe a turn in the business cycle where you might get higher savings rate at the same time as credit losses elevate, creating sort of a dual pressure on capital that subordinated debt could be used to help offset. And we saw a confluence of these factors really come together during the pandemic, and it really drove a lot of growth. There's some numbers on this chart in terms of new issuance, excluding the issuance to the Department of Treasury in respect of that public program, ESIP. This is just issuance to private investors. And you can see, during the pandemic in that 12-month period from the middle of 2021 to 2022, we really saw a dramatic increase in new issuance, almost threefold relative to the 12-month period before it. That was also a period where we saw some record-breaking pace of deal activity with respect to M&A. Of course, during the pandemic, like most depository institutions, credit unions were inundated with deposits. I think the average growth rate peaked at 20% in Q1 of 2021. So that drove a lot of interest in subordinated debt to kind of restore capital ratios to where they had been prior to the pandemic, and anticipate perhaps a difficult recovery from the pandemic, and allow credit unions to really keep a high level of engagement with their members during a period of time when they felt that their members needed them most. Since then, during the monetary tightening cycle, we've seen the growth in new issuance slow considerably, as you can see on this chart. And that's pretty obvious as to some of the reasons why. Organic growth is a lot more expensive. Deposits now a lot more difficult to come by. Of course, as Brian was mentioning, the cost of liabilities increased rather quickly, which did put pressure on margins. So subordinated debt, being one of the more expensive liabilities, became less attractive. But we still see higher or equivalent rates of new issuance as we did in that period before the height of the pandemic. So there's still a similar mix of use cases. It's just that the growth has slowed. Of course, we're seeing deal activity start to rage this year. If you look at the announcements with respect to bank acquisitions, only a handful of them have utilized subordinated debt. More than half of those are actually issued to the Treasury. But I can tell you anecdotally, based on our pipeline, it's definitely a use case that about half of our issuers are interested in. So it's going to be a driver. I think as rates come down, we're going to see some of the issuers that have been on the sideline, and there's a number of them, consider the market a little more closely. As Frank was mentioning, any issuance has to get regulatory approval, and we track that process through Freedom of Information Act requests. In 2022, there was over 1.2 billion of volume of new issuance approved for issuance to private investors. And as you can see, we certainly haven't filled that amount. And last year, there was about 540 million approved. Now that 2022 vintage, that over $1 billion of approval, that's due to expire. That is expiring this year. So it'll be interesting in the fourth quarter to see if we don't see a flurry of activity. But in our experience right now, we're seeing a lot of those issuers allow those approvals to lapse. And then next year, there's a pretty substantial amount of dry powder right now from last year's approvals, in addition to those that are being built up this year. So it'd be interesting, potential for some interesting dynamics in the market if conditions do shift quickly and issuers start to go to market. There's plenty of them that could glut the market potentially in a short period of time.